Hammer pattern. The hammer candlestick pattern is formed of a short body with a long lower wick and found at the bottom of downward turn. Hammer shows that although there were selling pressure during the day, ultimately a strong buying pressure drove the price back up. The color of the body can vary, but green hammer indicate strong bull market, then red hammer. Inverted hammer. Similarly, bullish pattern is inverted hammer. The only difference being that the upper wick is long while the lower wick is short. It indicates the buying pressure followed by a selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests that the buyer will soon have the market control, or the buyer will soon have control in the market. Bullish engulfing. It is formed of the two candle. It is form of the two candle. The first candle is short red body that is completely engulfed by larger green candle. When the second day is opens lower than the first day, the bullish market pushes the price up, culminating in a obvious win for buyers. Pricing line. It is also a two stick pattern made up of long red candle followed by a green candle. There is usually a significant gap down between the first candle closing price and green candle opening. It indicates a strong buying pressure. Strong buying pressure as the price is pushed up to or above the mid price of previous day. Strong red body on first bar. The close on the second bar must be more than the halfway up to the body of the first bar. Morning star. It is considered as a sign of hope in the bleak market downturn. It is a three stick pattern, one short body candle between a long red and a long green. Traditionally, the star will have no overlap with the longer bodies as the market gap both an open and close. It signals that the selling pressure of the first day is subsiding and the bull market is on the line or is in the horizon. Three white shoulder. It occurs over 3 days normally. It consists of long green or white candle with small wick which opens and closes progressively higher than the previous. It is very strong bullish signal that occurs after the downturn and shows steady advance of buying pressure and its potential directions is on the upward point. Hanging man. Hanging man is the bearish equivalent of hammer. It has the same shape but form at the end of uptrend. When the market is in uptrend, the hanging man will form. It indicates that there was a significant selling off during the day, that but that the buyer were able to push the price up again. The large sell off is often seen as indication that the bulls are losing control in the market, and the market is probably going in the downturn point. Shooting star. The shape is inverted hammer but is formed in upward form. Usually, it has a small lower wick on the body and long upper wick. Usually, the market will gap slightly higher in opening and rally to an intraday high before closing at a price just above the open. Like a star falling on the ground, the market will continue for losing its point from the downward. Bearish engulfing. It occurs at the end of uptrend of the market. The first candle has a small green body that engulfed by a subsequent long red candle. It signifies a peak or slowdown of the price movement and is sign of an impending market downturn. The lower the second candle goes, the more significant trend is likely to be. Evening star. Three candle pattern that is equivalent to bullish morning star. It is formed of a short candle sandwiched between a long green candle and red candlestick. It indicates the reversal of uptrend and is particularly strong when the third candlestick erases the gain of the first. Three black crowds. The three black crowds candlestick pattern comprises of the three consecutive long red candle with a short or non-existing wick. Each session opens at a similar price to the previous, but selling pressure pushes the lower price and the lower with close. Trader interpret this pattern as start of the bearish downturn, as the seller have taken the buyer during the three successive trading days. Dark cloud, dark cloud cover. It indicates a bearish reversal, a black cloud over the previous day's optimism. It comprises two candle, red candlestick which opens above the previous green and close below it midpoint. It signals that the bears have taken over the session, pushing the price sharply lower. If the wick of the candle are short, it suggests that the downturn was extremely decisive. Here is the highest price of the day, closing, opening, and lowest price of the day. Here is confirmations and opening price of the red candle stick. Doji. When a market opens and close are almost at the same point, the candle resembles a cross or plus sign. Traders should look out for a short to non-existent body with wick of varying length. This pattern conveys a struggle between the buyers and seller that results in no net gain for either side. Allowing a doji is a neutral signal, but it can be found in the reversal pattern, such as the bullish morning star and evening star.